In case you missed it, today was very much a red day in the stock market. In fact, if you check out all the indices here, you're going to see that everything was pretty much down. S&P was down 0.35%. The Dow was down 0.24%. NASDAQ down 0.53%. And the Russell was also down 0.62%. So what did a red day today mean to big tech stocks for companies such as Google? Well, let's take a look. Here's a daily chart going back to the middle of November. Let's take a look at how it got hit. If I plot the closing price here to where it closed today, January 5th, we see the stock is down almost 9%. And of course, Google wasn't the only victim here. Let's check out some of the other big tech stocks. How about Facebook, otherwise known as Meta Platforms Incorporated? Facebook is down $12.36, just over 3.5%. How about Nvidia? Nvidia also down $16.86, which is 5.75% off the market price. And then of course there's Apple, also down $4.78, just a bit over 2.5%. And of course, with all this red in the market across all the different sectors and industries, it has a tendency to make the retail investor run away scared, sell off stock, and panic. But since we're experienced stock investors and option traders, we know better than to panic. In fact, when we see all this red, the first thing that comes to mind is opportunity. So on red days today, there tends to be a lot of sell-off, so I immediately look for opportunities where stocks are oversold. Let's take a look at Google. Google closed at $27.53, just over 4.5% off market price. Google's a $1.8 trillion company, and it has an average trading volume of just over 1 million shares. Industry analysts give this stock a one-year price target of $3,366, which gives this stock an upside potential of just over 22%. Next, let's check out the industry analyst recommendations. Looks like industry analysts like this stock, and they give it a buy recommendation rating. Next, let's check out the option chain for selling a cash secure put using Google as the underlying stock. If I were to select a strike price of $2,670, that gives me a delta of 0.27, which is well under my threshold. So selling a cash secure put with a $26.70 strike price would pay me $24.55 per share in premium. Unfortunately, the amount of cash required to reserve as collateral for this option trade is cost prohibitive. So as an alternative, I could look to buying a Leaps option as a way to capitalize on this opportunity. Let's pick a strike price that's 1 year out. So I'm going to go to January 20th of 2023, and I'll be buying a call option. So for this opportunity, using a Leaps option, I would purchase a Leaps option with a strike price of $2,150. And the cost of purchasing this Leaps option would be $721.75 per share. So unfortunately, this strategy is also a non-starter for me because that equates to $72,175 in premium just to purchase the Leaps option contract. Well, if I don't have the money to sell a cash secure put and reserve as collateral, and I can't use a Leaps option and pay the premium required in order for me to hold that Leaps option, what else can I do? Well, in this situation, I might use a credit spread, and in particular, a bull put credit spread in order to capitalize on this opportunity. So a bull put credit spread is an option trading strategy that works well when I think that the underlying stock is not going to fall significantly during the life of the contract. In other words, I think that the price is either going to stay flat or go up, so I'm bullish on the stock. So in order to set this trade up, I'm going to set up a vertical spread, and I'm going to construct it using two put options, and more specifically, I'm going to sell a put option, and then I'm going to buy another put option at a lower strike price, but with the same expiration. So first I'm going to pick an expiration that's about 1 month out. So let's go to February 4th, 2022. Now the first step is to sell a put option. So I'm going to be selling a put option, and then I need to pick a strike price that I believe that Google will not fall below. Let's go back and take a look at the chart. So as I look at the chart, I see a support line right around $2,700. So looking at the option chain, I would pick the $2,700 strike price, And then next, I would buy a put option with the same expiration date, but a lower strike price. So I'm going to be buying a put with the same expiration, but a lower strike price. So in this case, I'm going to pick $2,690. And so you'll notice I've just created a put credit spread. And as you can see, the maximum profit from this trade that I can receive would be $345. The most I could lose would be $655. And my break-even price, the price of Google shares on expiration date, would need to be $2,696.55. So for this trade, I'd be risking $655 for the opportunity to earn $345. You can get near real-time trade alerts and notifications like this one by joining my Simple Trading Room community at discord.simpleoptiontrading.com. You'll also get direct access to me for only $1 for the first month, but you better hurry, this is a limited offer.